Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss what a lack of additional stimulus could mean for the economy. And Phil, before we get into that, I also want to review some COVID-19 data for this week. It's still clearly there, and we have cooler weather coming.
That's true, but I think we're starting to see proof that we know how to deal with it a lot better than before. I mean, if you look at the downtrend in the US cases that's now well and truly underway for what you could call the continuation or the second wave in America, where some of the Southwest and then the Midwest states could have caught the coronavirus. One of the things you see, if you look at the left and the right axis are obviously different, but if you look at the death rates, which is the black versus the blue line, which is the number of infections, that first wave, we probably undercounted infections because we actually had around about the same amount of deaths as we had in that second wave as it went through the Midwest. But both times we actually managed to get it under control. The other thing that you can see is that the deaths in total, which is the green line, were much worse the first time around because we didn't really know how to treat coronavirus. Now we've got much better once people get hospitalized, where people are actually coming out of hospitals much more healthily. And if we look at the experience in Europe, I mean, Spain is a really classic example. They've actually got more coronavirus cases now than in their original spike, but the death rate in Spain is only just ticking up a little. So I think we've learned not only if we wear masks and we socially distance and we shut down risky activities that we can get the caseload back under control, but the hospitalization is much better and the death rates are much lower than they were originally because we have learned from from the history how to deal with the virus.
Yeah, that certainly is encouraging. And I think the next thing that we have to look at as well is the risk of a recession. It's interesting. You're saying that odds from super forecasters show the probability that we don't get additional stimulus, and that's rising due to gridlock. It's so interesting. You can put odds literally on anything.
Yeah, and if you understand how the wisdom of crowds work, often the crowd is a better forecaster than any expert individually. So this is kind of interesting. We've got 7 weeks to go until the election, and I think that's, the politics is literally getting in the way of any kinds of resolution here. And so people are starting to expect that this will be pushed until after the election. It raises some interesting questions. I mean, without a second wave of stimulus, what will happen to employment? Will we have a whole lot more furloughs and more permanently unemployed people? Or is the economy recovering strongly enough that actually we might be able to muddle through anyway? Because most of the underlying economic data has been way less bad than people have been expecting. Even today, production numbers are much better. We've seen the unemployment rate improve much more quickly than we thought. But it's important just to remember that underlying all this, there's still a lot of people without jobs. So if you look at, say, rent, you can see that rent is actually falling along with the fact that people lost their jobs. So the joblessness is still a lot higher than it was pre-COVID. And if we don't have more stimulus, there's potential for a more classic recession to start, where lots of people don't have jobs, they struggle to pay rent. That becomes a problem for landlords, which becomes a problem for debt securities that have been issued on that sort of part of the industry. And we end up with a more classic, sort of longer tail recession to deal with as well.
So let's go to a topic that we've been covering quite extensively over the past couple of weeks and trying to discern where this stimulus money is going.
Yeah, and a lot of people think that it's been going into people's pockets and then going into their brokerage account. We know from the data that actually a lot of it looked like it got saved because we saw actually an increase in personal income, but a reduction in personal expenditure. Retail expenditure has now got back to pretty close to normal levels. But when we look at the activity on the stock market, it's been really elevated. And a lot of it looks like retail is more involved in the stock market. Some interesting data that came out from Goldman Sachs this week just looks at the fact that options are actually trading more than underlying stocks. So that's kind of phenomenal that the options market could be trading more than stocks. If we look at other data that we saw last week, one thing we can see is that the proportion of options trading in single stocks is actually much more small trades than it is large trades compared to normal. And the other thing that we can see is it's more single stock call buying rather than put buying. So that does sort of point to the fact that it might be a little bit of retail in the market, but it also shows that they might be buying upside to this market. So positioning for future inflation, additional stimulus, vaccines, helping us get back to normal and get all of those companies that are still not back to record highs or back to the start of year levels back into the economy and functioning again.
All right, Phil, great stuff. Thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.